Hi, I'm George Nordhaus, and welcome to Monday Morning. We never on Monday morning, or very, very seldom, talk about a coverage or any particular type of coverage because for a lot of reasons, but we're more marketing and management than we are coverages per se. But there's so much involved with workers' compensation that when I heard about Jon Coppelman's revised agent's playbook for workers' compensation, I grabbed on that one. John's with Renaissance and Group. Will John do this? Tell us about yourself a little bit, will you?
I'd be happy to, George. It's a pleasure to be here. I know that your relationship with my boss, Bruce Cochran, goes back 30 plus years,
That's for
and
sure. Yeah.
I'm pleased to jump in on it. This is my area, is workers' compensation. For 25 years, I've been educating and training insurance companies, agents, and insureds and workers' comp. I started back in 1990 when Massachusetts passed a comprehensive reform law for workers' comp. At that time, Massachusetts was ranked third highest for cost in the United States, and I'm happy to report that today we are ranked 48th. It's been an amazing turnaround, and a lot of it had to do with the training provided to employers. That's how I got involved.
Wow. Oh,
Over the
John.
course of time, I've trained not just employers in Massachusetts, but really across the country, including Fortune 500 companies, in the essence of managing workers' comp costs, which is what we're going to be talking about today a little bit. And for 10 years, I was a lead writer for the Workers' Comp Insider, which was the first blog dedicated to risk management issues.
Wow.
We started way back in the early 2000s, and it's still going strong. And
Great.
today, I'm the senior workers' comp consultant for the Renaissance Group, and I provide training and support to agents, and I also go out into the field with the agents and talk to their insureds or their prospects about workers' comp problems.
Well,
That's basically what I do.
that's an interesting point because with a Renaissance Insurance Group, of course, is an aggregator, and I mean, just a regular agent having somebody like you out there come out there. I mean, how many agents have that? I mean, they just don't unless they have an aggregator or something like that. That Bruce is thinking far ahead, and he got the right guy. Okay, what is this revised agent playbook? Why revised, etc.?
Well, workers' comp, I'm going to give a little history because I think it's important to remember its origins, and it's basically a little over 100 years old in America, although not all states had it 100 years ago.
Mm-hmm.
And the workplace has changed dramatically in those 100 years, and I think it's important for agents to recognize those changes and basically be up to date in how they approach workers' compensation with their insureds.
For
So
sure.
that's why it's a revised playbook.
Mm-hmm. All right.
So let's get started, and I like to start with the basics, and the first thing that everyone knows about workers' compensation, it's highly loss sensitive. When the more you use it, the more you pay for insurance, and the calculation itself is a little arcane, and it mystifies insureds, and mystification often leads to dissatisfaction. So it's important for agents to understand the calculation a little bit and help their insureds be comfortable with it, even if their mod is going well above 1.
Mm-hmm.
It's complicated. The whole issue of providing disability insurance for the workforce, it's a very ambitious project, and it doesn't always work perfectly, but the system is still functioning very well across the country. It's often confusing and infuriating to employers, especially when their mod suddenly goes up and they don't know why. And I think it's important for agents to be able to answer those questions to take away some of that confusion so that people know what's coming and where it's going.
Right.
And finally, it's a great opportunity for agents because there's so much confusion and pain around this particular line of insurance that it's an opportunity for agents to show that they know how to help, and that's the way to maintain your current book and to grow it as well as you talk to prospects who are feeling some of the classic workers' compensation.
Well, I think workers' compensation, that's right, is certainly the most argued about, complicated uh, coverage that we have in the industry. I've been hearing it for years and years and years. You don't hear it about auto insurance or homeowners or property or whatever. It really is, and that's why I'm particularly happy to have you. Go ahead.
Well, let's jump in, and I'll tell you a little bit of what we're going to cover today. I'm going to give you a little bit of a history of workers' compensation in America.
Hmm.
I want to talk about the American workforce because the basic way we work today is very different from the workforce 100 years ago, and we need to acknowledge those changes as we look at comp. Experience rating is traumatic when it goes bad. It's pretty good when it goes well. And I want to talk a little bit about the changes, radical, dramatic changes in the actual calculation of the experience mod. And finally, we're going to talk about the revised agent playbook. These are the crucial actions that agents can take to secure their base of workers' comp insureds and to grow it dramatically if they approach it the right way.
Good outline. Let's go.
All right, here's a little history. It's about 100 years old. You know, back in 2012, I actually went to a birthday party for workers' comp in Massachusetts. We were the second or third state, depending on, we're quibbling a little bit with Wisconsin as to who was second and who was third.
Hmm.
But it was 100 years old in 2012. By the 1940s, every state had its own workers' compensation program. So it's been here for a long time. And I like to remind people what the world was like before we had workers' compensation. Injured workers, if you're injured on a job, you had to sue your employer and as a tort liability. And you had to prove that the negligence on the part of your employer or one of your employer's agents in order to collect anything. And there will, needless to say, if you're dealing with the courts and you're going to court with a tort claim, there'd be long delays in payments. So even if you had a legitimate claim, you were getting bills that you couldn't pay for medical treatment, and you also had no wages coming in. So it was an instant poverty for the employee. And finally, if the employee was at fault, if they got injured due to their own mistake, they were totally out of luck. They had no recourse, and they were doomed to poverty for themselves and their families.
My guess is that
That
the
was
most controversy was right at that point.
exactly.
I could just imagine that happening.
It took such a long time for people to be made whole, which brings us to what I call the great bargain. It's the agreement that we all signed up for when we became employees. None of us remember doing it because it started 100 years ago. But the great bargain is that employers have agreed to pay the lost wages and health benefits for work-related injury and illness. They're going to cover it. At the same time, employees have given up the right to sue their employer for work-related injuries. That's the grand bargain. The lawsuit goes away, and employers are on for indemnity payments and very robust health benefits with no copays and no deductibles for employees. So it's a great program. It's a great bargain. And the premise that it began with 100 years ago still holds true today. Comp is still, for the most part, the exclusive remedy when it comes to recourse against your own employer for work-related injury or illness. There are a few exceptions that involve criminal negligence, so I'm not going to get into those kind of details today.
No.
It's no fault. Remember, before you had to prove that somebody else was at fault. Today, it's no fault. It doesn't matter who was at fault, whether the employee was at fault, whether the employer was at fault. It's still going to be covered. The one exception to that, by the way, is willful intent. If somebody is injured due to their own willful intent to cause injury to themselves or others, I think of these violent incidents where people bring guns into the workplace and shoot co-workers and then kill themselves. In those situations, the workers would be covered, but the employee who instigated the incident would be denied, and rightfully so. And one of the most interesting parts of workers' comp, and it frustrates me that we can't go into detail here, George, but it covers injury and illness that arises out of employment and happens in the course and scope of employment. This is where the case law from state to state comes into play, determine exactly what's compensable and what isn't compensable. I mentioned that it's a great set of health benefits. It's a nice indemnity benefit, but it's an exclusive club. You can only get into it if your injury arises out of employment and in the course and scope of employment.
Mm-hmm.
So in these cases, I always recommend to agents to advise their insureds, when in doubt, report the claim to the carrier and they will determine whether or not it's compensable.
Okay.
That's the general look of workers' compensation. Now I want to talk a little bit about the workforce and what it looks like, what it looked like 100 years ago and for some years after that. For the most part, you had a moderately skilled workforce, modest education, a lot of physically demanding jobs, manual labor. You generally went to work for a single employer for a lifetime. There was a lot of job security. People would join out of high school, they'd go to an employer, and they'd work there for 45 years, and then they'd retire at age 65. As we look at that now, you already know where I'm going with this. This is really not what happens now. We have a more educated workforce, but there are rapidly changing skill demands, and the kinds of people who are, I remember back in the 80s, there were a lot of high-tech training for computer careers, and those careers have changed a great deal since the 1980s, because we went from word processing centers from the Wang Computer Company, which is no longer in business, to laptops and our cell phones that are virtually traveling computers. So the skill demands have gone up greatly. People change jobs a lot now,
Mm-hmm.
sometimes because they're restless and they want to, but equally often it's simply because the job disappears. There's new technology that makes it redundant, and they have to go out and retrain themselves and find a new job. So job security is really a thing of the past, and it's very rare to find people who are staying with the same company for even more than a few years now. And retirement used to be something that was based on a guaranteed plan, at least certainly post Social Security. That's changed a great deal now, and employees are kind of on their own for retirement, and a lot of people are reaching retirement age without having set aside much money, which means they're going to end up working longer into their past age 65, into their 70s and beyond. And this raises really interesting cases when a judge is talking to an injured worker who's in his 70s and asks them, well, how long are you planning to work? And the injured employee says, well, I'm planning to keep going because I can't afford to stop.
Mm-hmm.
Then the calculation of indemnity becomes a little more complicated, because you can't assume we'll cut the indemnity off at age 65. It could very well go through somebody's 70s, and I've seen cases where they're working into their 80s. So that's changed dramatically. And the other thing really intrigues me, and I can't go into a lot of detail about it, but it's what we're calling the sharing economy. FedEx drivers, they are in FedEx trucks. They are wearing FedEx uniforms. They are following FedEx protocols. You don't see any ponytails on the drivers. They don't wear white socks. White socks but they are considered independent contractors, and that means FedEx does not have to pay benefits, and among the benefits would be workers' compensation.
Oh my gosh.
And there are lawsuits rolling from state to state to state, trying to bring FedEx, trying to overrule the independent contractor status of workers and bring them into the more conventional workplace model. And Uber, I mentioned Uber because it's an even more sophisticated model, because Uber drivers can, unlike FedEx drivers who have set routes that they have to cover, Uber drivers go out on the road when they feel like it and use the Uber app to get passengers. They too are independent contractors, and that is currently being challenged in California, and generally when things get challenged in California, they will roll eastward into other states. So 100 years ago, when you mentioned that somebody was an employee, you would have a pretty straightforward image in your mind. Today, it's much more complicated, and comp is caught in the middle of some of this stuff, where injuries to these independent contractors often end up on being determined to be that they are employees, and there are a lot. And this is a state by state by state issue. that is far from resolved. By the way, FedEx's strategy is simply to appeal. When they lose a case, they simply appeal it and keep the ball, pushing the ball uphill, and hopefully they won't end up with a day of reckoning where they owe retroactive benefits
Oh,
for all the employees who got injured.
can't you imagine what that'd be? Holy mackerel.
That would be a big number.
Billion, probably.
Now, at the same time, we're seeing radical changes in medicine. We're not just, obviously in workers' comp, if you break your leg is covered. But there are medical advances that have made the medical portion of workers' comp much more expensive than it used to be. There's the issue of widespread use of opioids leading to addiction. This is how that works. I mean, somebody has an injury, they're in pain. The doctor gives them a nice big prescription for a strong pain medication. They begin to get dependent on it, and at that point, they're not coming back to work. So what could have been a fairly minor claim that could have been resolved in a couple of weeks now may become a permanent and total disability. There's a lot of awareness about opioid abuse now, and many states are implementing protocols to limit the prescription of these drugs.
Mm-hmm.
And we also have new and treatments for things that nobody knew existed. Carpal tunnel. Carpal tunnel came in the early 90s when I started in this business, and I remember they were issuing videos to describe, they'd show a video with this, if you're feeling tingling in your fingertips, you may have carpal tunnel, and people would walk out of that video thinking, I have carpal tunnel. And I'm not minimizing that I'm not saying it's an illegitimate diagnosis, but it became almost a contagion where there were so many carpal tunnel surgeries going on, left hand, right hand, and then from employee to employee.
Have those calmed down a bit?
They have calmed down a bit. Yeah, they have calmed down a bit, but it's been replaced by rotator cuff surgery, which is, again, it's a very expensive surgery. Usually looking at a claim that's somewhere in the $100,000 range.
Wow.
Because of the expensive surgery and then the long-term indemnity for people to recover. And rotator cuff problems occur routinely in older workers who work above the shoulder level. So whenever I look at a sheetrock hanging company or carpenters, I expect to see a lot of rotator cuff there. And that becomes a factor in underwriting these companies and finding good coverage for them. And finally, this is one that hasn't really hit yet, but it's coming, and that's artificial limbs. In intense industrial settings, you often get amputations. We now have the technology to give people virtually working limbs as a result of sophisticated surgeries, and those costs obviously are going to get passed on to the employer through the experience rating system. So medicine changes, and we need to keep up with it as workers' comp evolves. It picks up a lot of these things that didn't exist just a few years ago. And I wanted to mention what I call experience rating trauma. NCCI handles workers' comp directly for about 38 states, and they advise a number of other states. The calculation that had been in place actually came in. Everything happened when I started, George. I don't know, it was just probably a coincidence. But back in 1990, they underwent a pretty radical change in the way the calculation was made. And they came up with a split point between primary loss and excess loss that I'm going to talk a little bit about. But I'll get to that a little later. In 2012, they began changing that calculation. And as it changed, it's always retroactive because workers' comp incorporates a rating period that goes back 5 years and includes 3 prior policy years. So when they changed the rules in 2012, it goes back to 2010, 2009, and 2008. And that's something that a lot of insureds, they were seeing some sticker shock as the rules changed. As I said, they're retroactive, and the split point between primary loss, which basically goes in dollar for dollar, 100%, used to be $5,000 starting in 1990 up to 2012. It was doubled to $10,000. It went to $13,500, and is currently at $15,500 in NCCI states, that changes the calculation quite a bit in terms of the impact of one large claim on your costs. And that's something that agents really need to be aware of. You actually did a training last year that incorporated an introduction to the new rating system, and that's an important thing to be aware of.
Mm-hmm.
Now, on the retooling, this is one of the unintended consequences of the new calculation. I'm talking about insureds. The vast majority of insureds in workers' compensation are under $20,000. Many of them are not even experience rated, but experience rating starts around $5,500 depending on your state. And I'm looking at premiums between $6,000 and $20,000 in premium. Buried in that premium are expected losses and expected primary losses. The expected primary losses for a premium in this range would be anywhere from $2,000 to $4,000. So let's say you had one claim for a small employer of a $15,000 claim, not a big claim by workers' comp standards. The average claim, the average lost time claim these days is about $55,000 nationally.
Oh, I got it.
So one claim, you got a relatively small claim, but look what happens. Their primary losses, their actual primary losses, because they're only allowed $2,000 or $3,000, are now 7 times higher than expected. That single claim will drive their mod well above 1.30. And it's supposed to be a measure of frequency, but in the case of smaller insureds, it's become a measure of severity as well. So your smaller insureds could get hammered if they have a single claim, and it's important. You can't make it go away, but you can explain it, and that's I spent a lot of my time holding hands and telling people why it happened.
Mm-hmm.
Let's talk about the revised agent playbook and what I think agents need to be doing to stay ahead of the game. It begins, to me, with claims reviews. Now, a lot of employers, in fact, I was visiting an employer yesterday, and when I asked them about the 8 open claims they had going back to 2012, and they said, well, the insurance company handles it, and they'll tell me when people are ready to come back to work. And I saw this as an opportunity to really empower this employer to get a lot more involved. And this is the kind of thing that agents should be doing as well. Every open claim needs a strategy toward closure. And you need to get on it as soon as possible. Any lost time claim, which generally, depending on your state, is either after 3 days, 3 days, or 5 days, in some cases 7 days, that's when indemnity starts to kick in. And you need to get on top of these claims right away before they go out of control. One of the reasons they might go out of control is somebody goes on their strong pain medications, they're not working, and all of a sudden you're dealing with a very large claim.
Mm-hmm.
The very act of scheduling a claims review, and this is something I suggest agents to do, call the carrier, and it might be more than one carrier if there were multiple carriers in the prior years, and you're going to be looking at open claims only. You don't have to look at closed claims. The scheduling itself makes sure that the pile of 130 claims that the adjuster has on the desk, they go through it and pick out your claims and make sure they've been paying attention to it. So if nothing else, the claims review gets the attention of the adjuster and makes sure that you get some good action out of it. I usually do these telephonically for very large accounts. When I was working with the Fortune 500, claims adjusters would come on site. But for most people, that's not necessary. You don't have that many claims to deal with. And the goal of these conversations on the telephone with the adjuster is to analyze what's going on with this particular individual, what the treatment plan is. Are we comfortable that they're moving toward a return to work, or is this claim going, as they say, south? Are the reserves appropriate? How much has been set aside for future payments, and what's the basis of that? When you ask about reserves, you're really asking about how much medical treatment is anticipated, surgery and follow-up, for example, physical therapy, and what's the indemnity projection? How long are they going to be on collecting indemnity for it? And the insurer has a unique toolbox that agents need to be aware of. They can set up independent medical exams where we think the treating doctor is being a little lax in their focus on getting someone back to work. they can assign nurse case managers, and if there are questions about whether something's legitimate or not, they can set up surveillance.
Mm-hmm.
These things will happen if you schedule the claims review, set the benchmarks, and follow up periodically with the adjusters to make sure things are happening when they're supposed to. So that's a very important part of the playbook. Tracking key benchmarks in the policy year. You know, a lot of times people say, well, the policy began, I don't have to think about it for 12 months. That is absolutely not the case. You have mods are going to change from year to year. So at the beginning of the policy year, let's just say we're going to start with a January 1 policy date. We have a new policy. What's the first thing I need to pay attention to? I need to do my claims review within 3 months of a policy starting. Why? Because 6 months once into the policy, the unit stat report, which aggregates all the loss data, is going to be submitted to calculate next year's mod. And if you don't have an intelligent discussion 3 months in about the reserves on any open claim, it's going to be too late to have that discussion 7 months in, or even 6 months in.
Good.
So you want to have that done. If you only do it once a year, do it 3 months into the policy. Now, as I said, once the unit stat is submitted, it's cast in concrete and nothing's going to change. 9 or 10 months in, you're going to begin to get the, you probably will see the promulgation of next year's mod. My motto is no surprises. If the mod's going up, you want to get in front of it and meet with your client. If the mod's going down, it's good news. You want to do the same thing. Go out and have a visit with them and congratulate them on their improved performance. And you want to check it for accuracy. They will recalculate a mod if there's a mathematical error. So you look at correlate the loss runs at the time of the unit stat report with what shows up in the experience mod calculation sheet. And you want to walk, as I said, walk the employer through any changes, whether they're up or down or even staying the same. And then you're back to the beginning of the policy again, and it starts all over. The only exceptions here, George, are accounts that are loss-free. Then there's very little to say and very little to do. But once they have a loss, you know, this is the tricky part. If I have a loss, I have a January 1 start date, and I have an injury in January, I'm not going to see the experience mod hit by that loss until 2 years out from that time. And so people tend to not focus on that particular injury. Sometimes loss-free clients are the ones at most risk because they don't know what to do when somebody does get hurt. So there's work on all accounts, whether they're loss-free or not. Now, in tracking the mod, the claims that go into the mod calculation go back for 3 years. If I have a January 1 start date, my units, let's say January 1, 2015, to calculate 2016, the data will be submitted in June of 2015. Obviously, 2015 itself is not going to be in the calculation. 2016 is going to include 2014, 13, and 12. So it goes way back in time, and you need to be aware of all the open claims in those years. I mentioned how primary losses have a big impact on your claim because they're not discounted unless they're medical only, in which case a large discount does apply. But if there is indemnity paid, that discount goes away. Excess losses are discounted substantially. As a rule of thumb, 90%, 85% of them go away, and only the remainder is included in the calculation. And each state has its own rating point, and this is the point at which a claim no longer impacts the experience mod. These caps range from the lowest I know of is in Maine, $138,000, still a very large claim, and in Illinois, a whopping $343,000 of each claim. So if you have a catastrophic loss in Illinois, you'll have primary losses of $15,500, and then up to the $343, about, depending on your size as an employer, a substantial portion of that is going to be included in the calculation.
Well, it's really
important to know. Yeah, go ahead.
Well, I was just thinking of the complexity of this thing. Every time I talk to somebody at workers' comp, I'm more and more amazed at how much you really got to know. I mean, this is amazing. I didn't realize the cap was was that low or that high, either one, for one.
Exactly, and they change occasionally too, and states play with these caps. Although of the last few years they've been fairly stable, but it's important to know it because I often run into a situation in a claims review where I'll have a $200,000 claim, and they're going to increase the reserves because there's been a setback, and they're going to go to $400,000. And the initial response to the employer is, "Oh my God, this is going to kill me."
Uh-huh.
And I just whisper to them quietly, "Your state rating point here in Massachusetts is $175,000, so it's not going to impact you at all. So don't worry about it." It's
Got it.
important to know when you're kind of playing with house money.
I can imagine. Yeah.
Yeah. And the next thing is modified duty. Everyone knows now that when I started in 1990, modified duty was kind of rare. People they eventually got aware of the fact that it helps get people back to work faster. It helps people just to get dressed in the morning and go to work. They still think of themselves as employees, even though they're not doing their regular job, even though it's lighter duty jobs. Temporary modified duty is a really important tool, but it's not a tool. It does speed recovery, because if I don't get dressed and go to work, if I'm sitting at home waiting to get better, a number of things happen. My inactivity becomes part of, impedes my recovery. I'm watching TV in the afternoons, and I'm going to see a lot of attorneys promising me a lot of money because I got hurt on the job.
That's for sure.
So it changes the whole scenario if I can get dressed and go to work. But one size does not fit all in temporary modified duty, and I think a lot of times when you talk to insurance companies, they basically want temporary modified duty to be used 100% of the time for everybody who gets hurt because they want to drop that indemnity level. I look at it more strategically. If, for example, if someone has a difficult injury to accommodate, bring them back a couple of days a week just to get them, again, dressed and go to work, even though it's only 1 or 2 days a week. It's part-time, it's intermittent. It's still better than nothing. As I like to say, any work is better than none. And if someone, for example, has a hernia and they're going to have surgery, I don't recommend light duty before the surgery. Let them stay home and rest, stay in touch with them by telephone, and bring them back to work post-surgery on temporary modified duty. It's not. It has to be a goal toward full return to full duty, and you're not going to even start the clock until someone's had their basic surgery or treatment or whatever they're going to do to get there. And the other thing important about modified duty, a lot of employers make the mistake. They put someone in a very cushy, light job. They normally have a physically demanding job, and then coworkers who are, doing all the lifting for them start to resent it, especially if the injured worker has a big smile on his face. So you want to make it progressive, and as they recover, get the doctor to increase the job demands a little bit. They can now lift 15 pounds. They can now lift 25 pounds. Make it progressive to ease them back toward their full-duty job. It's very easy to mess up temporary modified duty, and employers need help in structuring it and making sure it's working in the best interest of both the employee and the employer. The next part is staying ahead of the curve. I mentioned the changes that have recently come to the calculation itself through NCCI. You want to track those changes. I was getting a lot of calls in 2014 as the split point went from 10,000 to 13,500. I was seeing experience mods where there were no new losses, but the mod was going up. Well, why was the mod going up? Because the split point went up, and it changed the calculation. And that confused a lot and angered, quite frankly, a lot of employers. So it's important to know what those changes are and keep ahead of them. And there are also changes in state laws, and this raises a very interesting point, which has been described by some people as a race to the bottom. Comp is competitive. If you're in Connecticut, the #2 state for cost in the country, and you're competing against Massachusetts to try to get business, there may be a lot of reasons not to go to Massachusetts, but workers' comp isn't one of them because it's relatively, it's one of the cheapest states for comp. So in the race to the bottom, and I don't think Connecticut's involved in this, but there have been moves to limit compensability for some claims, discussions about eliminating anything that involves normal wear and tear of the body, even if work contributed to it. Legislatures are tightening eligibility in order to lower the cost of comp to their employers. I don't see it as radically as happening as radically as some people do, but it's something to keep an eye on. Know what's going on in your state, and quite frankly, if I were an employer in Connecticut, I would be in touch with my Chamber of Commerce and saying, help us. This is it has really gotten out of control. Fee schedules. One of the key ways to control costs in workers' comp are fee schedules. Limit the amount of doctors paid for a given procedure. It's one of the basic accomplishments of the 1990 reforms in Massachusetts. They implemented one of the lowest fee schedules in the country. And a lot of people say, how did you get away with that when you've got this wonderful medical infrastructure and some of the best hospitals in the world? I think it happened because it was early on and the doctors didn't really pay attention to it. And what happens, by the way, in Massachusetts is a hand surgeon, the fee schedule is $735 for hand surgery. No self-respecting hand surgeon is going to do surgery for that amount of money. No. So you negotiate a higher fee. You're not limited to the fee schedule, and if it's a good doctor and you want that doctor, you simply say, okay, we'll give you your usual fee or we'll negotiate your fee. Now, Maine, this is an interesting little anecdote. Back in 1992, Maine legislature said, we want a fee schedule. It took 20 years to put that fee schedule in place. Why? Because they kept asking doctors, how much do you think we should cut your fees? And you know what a doctor's going to say? Don't cut them. Don't do it. Yeah. And so it took them 20 years to come up with something that the doctors could live with.
Amazing.
And my informal advice would be, don't ask the doctors. But I know that's politically very difficult to do.
Let's don't get into that one.
Right. Serving in legislatures. And the other changes that take place are in case law. And what's compensable, when is somebody working, when are they not working. All of these things evolve from year to year. You don't need to become an attorney here, but it's a good idea just to keep your ear open to what's going on in your particular state. And for most agents, you're dealing with people who might be working, who might have employees in different states. And it's important to know what's going on in the other states as well. And staying ahead of the curve again, identify at-risk accounts. You want to do part of that periodic review. You want to know whose mod's going up, and some of the risks, by the way, are not just whether the mod's going up, but is a company expanding? I think expanding companies are at high risk in workers' comp because they're hiring strangers, and a lot of times they're doing it in a hurry, and that can backfire on you very strongly. And the other danger point, the red flag, is a contracting company. Companies are laying people off because what happens once you lay someone off, you've broken the bond between the employer and the employee. And, I've had this sore back that's been with me for years, but now that I no longer have a job, I'm going to go to find a doctor and see if I can't get on workers' comp. Because for aging workers, and we won't talk about that a lot today, but for the aging workers, sometimes workers' comp is the retirement plan for people who don't have retirement plans. In other words, they can get indemnity payments for a long period of time, much longer than, for example, unemployment would ever pay. And once agents have all this in mind, they have the expertise not just to hold on to the business they've got, but it's the kind of expertise you need to grow business. You can meet with prospects and talk intelligently about somebody's experience mod, where it's going, why it's going, and how to manage claims, how to keep it all very positive. It's a proactive approach with prospects that can lead to new accounts.
Wow, a lot going on here.
A lot going on, and you know, as you can see, I tend to get kind of wired into this stuff
Well,
because
I mean, you're
it excites me. You know, when people say insurance is dull, and I don't know what they're talking about. I mean, maybe there are forms of insurance that are dull, but in workers' compensation, you're talking about pain, injuries, psychology, um, attitude toward life and work. It's an amazing potpourri of all kinds of ingredients. One of the things I look for in employers is, do they respect their own people? Do they like their own people? And if I do underwriting surveys for carriers, and I always look for that. If an employer seems to have contempt for his workers, I think that's a very bad sign, especially with regard to workers' compensation.
mm-hmm.
So here we are. We're going to track the playbook, the revised playbook, the new aggressive, revised, proactive playbook. You're going to track key benchmarks throughout the policy year. You're going to facilitate claims reviews for companies with a couple of open claims. You can probably do it once a year with a follow-up on those individual benchmarks that you set. If they have 10 or 12 or 15 open claims, you're probably going to do it quarterly. And these will be some of your largest and most valued accounts, so it's definitely worth the effort. You're going to anticipate changes in the experience mod and be ready to explain them. You're going to coach accounts in how to use temporary modified duty effectively, cost-effectively, and in terms of achieving your goal. The goal of modified duty is simple: getting people back to their regular job. And finally, you're going to stay informed. You're going to know your own state and understand what's going on in your state. You're going to, there are bills that are going to be proposed that might improve comp for your state or make it more difficult, and those are things that you want to keep keep track of. And you're going to use your expertise, all the areas that we've talked about this morning, to grow your business. And that's part of the playbook.
I hear the excitement in your voice. I can see why why you've been teaching it, and gosh almighty, I'm really impressed with what you've just done. I realize you work with Renaissance. Let's talk about them just a little bit before we end here. I know that, well, either one of us could talk about this because I've been working with Renaissance for years and years.
Yeah, and you know Bruce very well, and you know the model. We have a network of about 100 agents across New England, and what we try to provide is state-of-the-art services in policy issuance and all the technicalities of running an insurance agency, so that we can free them up to do what they do best, which is to sell their business. And these agents get the benefit of the clout of aggregated premiums. You know, we're up over $500 million in premium, so we get lots of carriers to choose from. We have lots of flexibility. It's a great approach. It's the combination of your local neighbor agent with the power of a much larger agent. It's a very powerful combination. And my role in it, my role is just basically around the workers' comp issues, which tend to be some of the most volatile issues. And I have the fun of working and training agents and then going out into the field with them and meeting with their insureds and with their prospects to try to explain what's going on in workers' compensation and get them a little more comfortable with it.
So
that's us.
That's the Renaissance. How can they get hold of you, too?
Here's my contact information. And that's my direct line there. We are in Wellesley, Massachusetts, which today is under a downpour, but tomorrow will be sunny, I hope.
I'm sure.
And I've been with Renaissance for about 3 years. I've known Bruce for a lot longer than that. Prior to that, I was with a national consulting firm, Lynch Ryan, and Lynch Ryan does the blog that I mentioned earlier, and that's still going.
I suspect that you're going to get some calls from people wanting to know various things. And can you still consult with somebody in Tennessee or something?
Absolutely. I've worked all over the country, and I'm happy to take phone calls and figure out what I've been criticized for giving it away as opposed to selling it, but I'll do my best to help people who have concerns or issues that they may want to run by me.
Oh, that's wonderful, John. I really greatly appreciate it. The Renaissance, incidentally, is one of the aggregators that sends out Monday morning to all of your people. In fact, you got like 500 on your list, and it's
Yes,
just it's really
that's right.
nice for me. I've been working with Lisa Johnson and Bruce for a long time on that. Well, I want to thank you again. This is just exactly what I wanted. But once I heard about it, and boy, oh boy, you are one whale of a presenter. I guess everybody else has told you that too. But boy, I wish they were all that way. Okay. And
I have fun with it, and it's been great working with you, George. This has been a lot of fun for me.
yeah, it really is. And I enjoy it thoroughly every week. Okay. And for the rest of you, I'll see you next Monday morning.